Mary Hines was invited to be part of this panel. That is the elderly woman I referred to in my opening statement who was victimized. She is not well and has submitted written testimony for the record that we will make part of the record because she was not physically able to make it here today to talk about her situation. And as I briefly talked about in the opening, and maybe you all can speak to that, I know that Daniel, I think, is familiar with her case. This is a situation where money was set aside of the proceeds to fix the roof so it would pass HUD inspection for a HECM reverse mortgage. And unfortunately, the repairs that were done were substandard, didn't work. Instead of replacing the roof, they merely spread tar in a couple of places, so the leak was not fixed. So as a result, the leak continued, the money had been spent, and she still has a leaky roof, which was the main reason she got the money in the first place, was to do that. And that was just a matter of the lender in that instance not supervising the repair work and certifying the repair work had been done correctly prior to paying the people who had done the repair work. And they had taken on the responsibility of that repair work as part of the mortgage agreement, and then they failed to supervise it appropriately and withhold the payments until it had been done right. And then she kind of got left holding the bag. So that was her situation, and her written testimony will be made part of the record. If this is a good lending tool, if this is a good value for the federal government, why isn't there a proprietary market?
Well, there's a lot of reasons not a proprietary market. First of all, it's a small market. Even with the growth we've had, we're doing 100,000 loans a year nationwide. We have a code of conduct that requires, code of ethics and professional responsibility, that requires all members of our organization to follow a number of procedures, and we, in effect, make the same rules of HECM applicable to all other reverse mortgage products.
You got the front group, I shouldn't call it the front group, the originating organization, you have the servicing organization, and then you have the investor.
Right.
And the investor is us, right? It's taxpayers.
No, not true at all.
Well,
well, I guess now that we own Fannie Mae, yes, but prior to the taxpayers taking over Fannie Mae.
Well, we own it now. The success of Fannie Mae is completely dependent upon the American taxpayer, right?
Well, the success of Fannie Mae is based on its prudence in acquiring loans.
I should say the risk associated with Fannie Mae is the taxpayer's risk. We've
learned
that. Fannie Mae began to go belly up, and we had to step up and provide the money. So we've learned unequivocally that the taxpayer is the one that has to step in if Fannie Mae flounders. So what I'm trying to figure out is if this is a good product. You know, I get people calling me all the time and say to me, you know, Claire, why doesn't the federal government get its big nose out of the private market? You know, if we just get government out of business, business would thrive in this country. But clearly this is a product that people are making money off of, but the only risk, really, if these mortgages don't work, is with the government right now. Does the originator have any risk? Is there any risk at all associated with the originator?
There is risk right down the line, and there's the risk that if the loan is not made properly, then HUD might not issue an insurance certificate on it. So there is risk.
There's risk if they don't do it right.
There's risk if they do not do it right.
Okay. But I'm talking about risk in terms of investment risk, in terms of the loan not being able to, in fact, be repaid. Is there any risk at all with the originator in terms of the loan not being repaid? Why aren't there proprietary loans being made now?
Because there's not enough volume out there for somebody to make the investment in the equipment to pursue this.
Well, but these companies have the investment. They're doing HECMs now. Why don't they do proprietary?
They are not the same systems that you need to do for it. And the other reason is that the proprietary market, when it was there, once again, I mentioned it was for much higher value homes. The difference is on FHA, because there is a mortgage insurance premium, so therefore if the loan is upside down at the end, the investor, the lender, has the opportunity to file a claim with FHA for the difference to be made whole. means that they lend a lot more money than they would on a proprietary product that didn't have that insurance.
Yeah, because the government is on the hook. They can make more money up front.
No.
Yes,
no,
because they can loan more money because they're not taking the risk, Mr. Bell. That's exactly the point. And that's the whole reason this front end has become incredibly scrutinized right now. Because the back end, and by the way, as we pointed out in the last panel, there's a long tail here. We have lots of reverse mortgages that have been made that we will not know in this current market whether or not they are upside down, maybe for another 5 or 10 years when we could have interest rates up and property values down.
But we do know that we've had reverse mortgages that we've made since 1989 that have paid off completely and have been extremely profitable to the United States government, putting in billions of dollars into the FHA fund. This year, for the new budget, the Secretary has decided to ask for some credit subsidy based on some new changes to the assumptions of home price appreciation for the 2010 book of business, as well as interest rate assumptions. But if you look at prior years, the program was considered to be extremely cash positive, so much so that the department itself, under the prior administration, which was a pretty fiscally conservative administration.
We might quarrel about that.
Right, well, I guess, yeah, as I said myself, as I heard myself saying that. Right. But in this program it was, in this particular it was, that they were even talking about reducing the mortgage insurance premium, because one of the criticisms of the program is that consumers pay a large upfront charge to get involved in these loans. And the most significant portion of that upfront charge is the mortgage insurance premium that's paid to the federal government. It is not the fees that are paid to the lender, which are capped.
Which, by the way, this is an equal opportunity sin. You are exactly right. I discovered when we started looking into this product that part of the problem was Congress's voracious appetite for more money to spend. They love this product, the appropriators do, because we're able, with CBO scoring, to actually create money for us to spend today based on these loans being executed. So it is, and that's why I think it is another reason that we need to take a careful look at this product, because I ran into appropriators when I was trying to limit this. They were wanting to take the roof off because they love having this money to spend, and they're spending it every year. We're spending it every year that are coming from these loans. This is not sitting off in some insurance fund. They're spending it. They're spending it. So I think but I think the overall point I was trying to make was that their risk here for these loans being upside down is not being borne by the private market, even though the private market is out there marketing them. Let me ask you this. Do any of your members do commercials that say this is a government benefit?
A government benefit? No.
None of your members have any commercials that say...
If they did that and it were to be reported to us, we would take swift action through our ethics committee. We have done that on a number of occasions. Now, some of them may say that it is an FHA-insured reverse mortgage, which is factually correct. But to say it's a government benefit is completely unacceptable, misleading. It's a violation of our Code of Ethics and Professional Responsibility. It's a code of our Ethics Advisory Memoranda. And we do take action against anybody that does have ads of those sorts. And have taken action.
And I promise I've got questions for both Mr. Claggett and Mr. Zeman, but I have one more question. Mr. Bell, are you aware why the recently passed legislation, the House exempted reverse mortgages on all the truth in lending requirements?
Yes. There has been a tendency over time to adopt legislation to deal with mortgages across the board and say it includes reverse mortgages. And then we find very often it doesn't work because reverse mortgage is so different.
Well, both of them embrace an obligation to pay.
They do, but they have a lot of different things that occur through the life of the mortgage.
Well, the AARP brought this to our attention, that they had been left out of the legislation, reverse mortgages, and I'm sure that you will be happy to work with us in the Senate to make sure that we put appropriate measures in this consumer-oriented bill in terms of protecting consumers that do appropriately apply to reverse mortgages. I think the problem is if we're dealing with the subject matter of consumer information, and making sure a consumer is informed, you may be well and right that an escrow for insurances and taxes is not something that must be included in a reverse mortgage. But it would not surprise you to know that there might be people that may not realize that their reverse mortgage did not include the payment on insurance and taxes, and those go unpaid, and then you've got a situation where that homeowner is in fact has not been fully informed.
We do try to make sure that all borrowers understand their obligation to pay taxes and insurance. There is a form that is often part of the closing package that reminds them that. It is something that comes out with reminder notices and servicing notices that go out monthly. In fact, we're working with HUD to make that a required practice rather than a voluntary practice.
Well, but the motivation for the insurance, I know when I entered into mortgages, the bank requires that we can document the insurance is paid. But the problem with reverse mortgages is if there's no insurance on the home and the home burns down, who is responsible for paying back the loan?
That would probably be a claim to FHA at that point.
It would be
Well,
the
the
taxpayers.
borrower would be, right? The loan would become due and payable.
The taxpayers have an interest in that piece of property being insured. They're on the hook.
The taxpayers, but once again, it's not the taxpayers' money, it's the insurance fund, which has been paid for by those people who have utilized the program through the mortgage insurance premiums that they pay into the fund.
But the point is that money is not being provided. I mean, and by the way, it's just like Social Security or any other government insured program. If the money is not there, the taxpayers pay. If those insurance premiums are not sufficient to cover the losses, the taxpayers pay. And so what I'm saying is there is a great motivation on part of the government to make sure that not just the taxes are paid, but clearly the insurance is paid. That would be
There's no question. There's a great motivation on everybody's part to make sure that taxes and insurance are paid.
Is there any sense of the people in the rooms you're sitting with in Washington that, I mean, I'm not a dumb person. I'm pretty smart. I've got a law degree. I've spent a lot of time in the law practice and in the legislature, and I have spent a year and a half trying to completely understand this. And this is complicated. And the yield spread issue is complicated. And what Buzz is telling you is that he's a good counselor. And he is telling you that he cannot counsel seniors with any certainty about how much these loans are even going to cost them prior to the time they sign away their life savings.
Well, no, they know prior to closing. There's a full disclosure of full numbers.
Do they get counseling again?
Prior to closing. They can go back to the counselor if they choose to.
But they're not required to.
They are not required to.
And
you
so
could
what I'm
add a
saying is
second step to the counseling process if that would be desirable.
How about if we just make them lock in rates?
Well, the problem with locking in rates, as you know, that's been done
used to
historically.
do it.
Yes, and then we had periods where no money was available because the locks were below where the cost of capital was.
Well,
that's why most governments do not set interest rates anymore. And in fact, that's why HUD does not set the interest rates or the margin rates on HECMs.
Well, I think that obviously the follow-up to this hearing, one of it is with Fannie to talk about what is going on as it relates to these loans, because I worry that in the process of adjusting to this market, that we're shifting the risk to taxpayers completely and totally, and secondly, we're making it so much more complex for seniors to truly understand where they stand and what they're getting into and what the consequences are to them and their families. And after all, that's how we began down this road. It started as an idea to make it a simple, understandable transaction that would be affordable for seniors to access some of their equity to deal with the problems they're facing. And if we get to the point that one of the best counselors in the country on this, first of all, doesn't even understand what's going on, doesn't understand how to explain it to the people as to what's going on with the rates, and the rate is a pretty important component of this whole thing. I think we've got an issue. I think somebody in Washington needs to go, wait a minute. I think we are so caught in the weeds of this market and the cost of money and what's going on in this economy that we're losing sight that seniors aren't getting the information they need and deserve before they enter into these instruments. And Mr. Claggett, would you comment on that in terms of the people you're talking to? Have you dealt with clients that have had problems with these mortgages?
you mentioned with Mary Hines, who's being represented by Lewis, Rice, and Fingerish under our Legal Services Pro Bono program on a variation of that situation. With this particular client that we're handling, she took out a reverse mortgage that paid off a forgivable loan that was for home repairs, and sort of to add insult to injury, that work that was done in connection with that forgivable loan was done in a shoddy workmanlike manner. So as in Ms. Heinzer's case, where the money was released and all leverage over the contractor to fix the problem is now gone, that's similar to what is happening in this client's situation as well.
I think it's important to remember that we're not there. I mean, when the GAO does a secret shopper program, and I believe his testimony was 14 out of 15 or 15 out of 15. 15 out of 15 counseling sessions that GAO set in were not sufficient in terms of information that was provided, whether or not they were actually counseling for the amount of time they were charging for, all of those issues. If you're 15 for 15 in a secret shopper program, then I'm not sure the seniors are getting the kind of help they need before they enter into one of these loan agreements. And I think Congress has a responsibility to make sure that we continue to maybe institutionalize the GAO secret shopper program so that counselors know that at any given moment, the person sitting across from them could be someone that is going to be passing judgment on whether or not they're doing an adequate job of informing the seniors of all the risks and the rewards that come with a reverse mortgage. I want to thank all of the witnesses today. I appreciate you being here. I think that my closing comments would be that to any senior that is looking at a reverse mortgage, go carefully, go thoroughly, make sure you understand all the fine print, and remember the most important thing that you could ever know, and whenever you're embarking upon any kind of financial transaction, if it sounds too good to be true, it usually is. Thank you very much.